Hey everyone, welcome back to the channel. Something really important happened in the markets on January 29, 2026, and it had nothing to do with a flashy AI demo, a trillion parameter model, or a surprise product launch. It was a moment when Wall Street quietly changed the rules of the AI game. On the same day, two of the biggest tech companies on the planet reported earnings. Both are spending absurd amounts of money on artificial intelligence. Both are chasing dominance. And yet, one company lost more than $350 billion in market value, while the other gained nearly 10% in a single session. Microsoft beat earnings and got punished. Meta doubled down on AI spending and got rewarded. That contrast tells us almost everything we need to know about how AI investments are being judged in 2026. Microsoft's pain was immediate and brutal. Despite reporting adjusted earnings of $4.14 per share, well above expectations, the stock dropped about 10% the following day. That erased roughly $357 billion in market capitalization, marking Microsoft's worst one-day decline since the COVID crash. On paper, the numbers looked solid. Revenue beat estimates, profits were strong, but investors weren't reacting to what Microsoft earned. They were reacting to what Microsoft chose not to do. During the earnings call, Microsoft CFO Amy Hood made an admission that quietly rewrote the entire narrative. When asked why Azure's growth slowed from 40% to 39% despite record AI spending, she said, Microsoft could have delivered growth above 40% if it had allocated all newly available GPUs to Azure customers. Instead, the company chose to hold back that compute and redirect it toward internal AI projects like Microsoft 365 Copilot. That single statement explained everything. Microsoft isn't constrained by chip shortages in the way the market assumed. It's deliberately limiting the growth of its most profitable business to fund internal AI development that doesn't yet have a clear revenue model. From a long-term strategy perspective, that might make sense. Microsoft wants to reduce its dependence on OpenAI, especially now that OpenAI has the freedom to run workloads across multiple cloud providers, including Oracle. But, from Wall Street's point of view, this looked like management choosing speculative internal R&D over immediate proven customer demand. Investors don't like that trade-off. Azure is widely viewed as Microsoft's future growth engine. Independent researchers like SemiAnalysis had forecast Azure growth could reach as high as 54% by late 2026. Instead, Microsoft guided to growth of 37 to 38% going forward, citing AI hardware capacity constraints. That gap between expectations and reality is what triggered the sell-off, not the earnings beat itself. Microsoft is now stuck in what analysts describe as a kind of prisoner's dilemma. If it allocates more compute to Azure customers, it boosts near-term revenue but risks weakening its own AI products like Copilot and Office. If it prioritizes internal AI development, it protects long-term strategic positioning but caps Azure's growth. On January 29th, the market made it clear which choice it prefers, at least for now. While Microsoft was getting hammered, Meta was having the exact opposite experience. Meta didn't just report strong numbers, it told a story that Wall Street found completely believable. The company announced plans to increase AI-related capital spending by as much as 87%, bringing total infrastructure investment to $135 billion this year. That's more than the annual economic output of many countries, and instead of panicking, investors pushed Meta's stock up about 10%. This wasn't blind optimism. Meta showed receipts. Meta's Advantage Plus AI advertising platform now handles more than $60 billion in annual ad spending. Lead generation campaigns using Advantage Plus cost advertisers 14% less than traditional methods. In the fourth quarter, the average price per ad rose 6%, driven directly by AI-powered targeting improvements. Most telling of all, 60% of all content viewed across Instagram and Facebook is now selected by AI recommendation systems. That matters because it connects compute spend directly to revenue. Meta's CFO Susan Lee spent the earnings call walking investors through exactly how AI investments translate into money. AI reduces friction for advertisers, it improves targeting accuracy, it increases user engagement, and that allows Meta to charge more per impression while delivering better outcomes. This isn't speculation about future breakthroughs, it's measurable impact showing up in quarterly results. Meta reported 26% revenue growth, an 8.6% earnings surprise, and operating margins of 41%. Advertising accounted for 97% of total revenue. During the December quarter alone, Meta generated nearly $60 billion in revenue. For all of 2025, it brought in $201 billion, up 22% year-over-year. The company is projecting growth of up to 34% in the current quarter. Those numbers changed the narrative around Meta's AI spending overnight. When Mark Zuckerberg first announced these massive infrastructure investments back in October, the stock dropped about 7% after hours. Investors were worried Meta was burning cash chasing superintelligence. But now, with proof that AI is directly boosting ad performance, sentiment flipped completely. Susan Lee explained why the spending is accelerating. Demand for compute across Meta has grown faster than supply. The company doubled the number of GPUs used to train its ad ranking systems in the fourth quarter and introduced a new learning architecture. As a result, Facebook ad click-through rates increased 3.5%. Instagram conversions rose by more than 1%. Across all platforms, conversions increased 3% due to AI enhancements. Meta is also seeing traction from automated ad creation tools. Revenue from AI-powered video generation reached a $10 billion annual run rate in the fourth quarter. As one analyst put it, the more compute Meta feeds into its ad platform, the better it performs. And when yesterday's spend shows up as this month's growth, the incentive to keep spending becomes obvious. Underneath all of this is a resource war that neither company talked about directly, but both revealed through their actions. There simply aren't enough top-tier GPUs to do everything at once. Companies have to choose how to allocate compute between training new models, serving cloud customers, improving consumer products, and replacing aging infrastructure. Microsoft chose to prioritize internal AI development. Meta chose to prioritize its existing advertising machine. That difference explains the market reaction. Microsoft's approach may pay off years down the line, but today it looks like sacrificing known revenue for uncertain future gains. Meta's approach improves the present by making ads more effective. Meta turned GPU scarcity into pricing power. Advertisers are willing to pay more because the results are better. There's also a risk factor that many investors underestimated in Microsoft's case. Microsoft's reported $625 billion revenue backlog looks impressive until you break it down. Roughly 45% of that backlog is tied to OpenAI. OpenAI is still not profitable, faces growing competition, and now has the explicit ability to diversify its cloud infrastructure away from Azure. If OpenAI grows faster while reducing its reliance on Microsoft, that backlog could unwind much faster than investors expect. Meta has no such concentration risk. Its revenue comes from millions of advertisers across industries and geographies. Even if large advertisers pull back, AI improvements make the platform more attractive to small and medium businesses that previously couldn't compete. The broader market signal here is impossible to ignore. This isn't really about Microsoft versus Meta, it's about the AI boom entering what can only be described as the show me phase. Investors are no longer paying for ambition alone, they're demanding proof. AI spending has to show up in revenue, margins, and growth within quarters, not years. Microsoft will likely resolve its strategic tension over time. Its technical capabilities remain strong, and Azure is still a dominant platform. But January 29th set a new bar. AI investments that cap current growth without delivering visible returns will be questioned, no matter how visionary they sound. Meta's surge validated a different approach. Use AI to strengthen an already profitable business, make the payoff obvious, scale what works. It may not sound as futuristic as building entirely new platforms, but in 2026, it's clearly what the market wants. The lesson is simple and uncomfortable. Execution now beats ambition later. Measurable returns beat strategic positioning. And in this phase of the AI race, the companies that can prove their spending is working today will outperform those asking investors to believe in tomorrow. That's the shift we just witnessed. Thanks for watching. This is AI Tides, and I'll see you in the next one.